Good afternoon, everybody. Thanks to those that are joining us today for the capital gain exclusion rate change update. And for those that are tuning in later, either through YouTube or through a recording, welcome to you as well. Before we get started on the content, we'll just wait a couple of minutes just in case anybody else is coming in. In the meantime, I'll introduce myself and we can walk through kind of the agenda on what we're expecting today. So my name is Blair Duffy. I'm a partner at Hendry Warren. I've been with the firm since 2008 and have been a partner since 2016. Most of the work that I do is with small and medium-sized owner-managed businesses. Many of those companies have holding companies or have investments in their corporations. And so certainly these rules have a big impact on my client base. And so over the past few weeks, there's been a fair amount of uncertainty as to whether these rules were going to be put through or not. And for those of you that are following in the news, you would have seen that yesterday the government had a vote on the capital gain exclusion rate change, and it was passed by the government. Not surprisingly, the Liberals, NDP, and Bloc voted in favor, and then the Conservatives voted against the policy change. And so at this point, it's a done deal. It's happening June 25th. I was joking earlier that we had to go through and change the presentation a little bit to get rid of the proposed changes and just exclude that because now it is set in motion. So with that, why don't we get started? And so just before we get in to the content and what the discussion points are today, I just wanted to throw in a disclaimer that each individual's tax circumstance is very different. And so the discussion today will be in broad terms. We'll be talking about different considerations that you can be thinking of, but certainly, do speak to a financial advisor or accountant prior to making any changes, as your situation may be different and may not be applicable to what we're talking about. Throughout the presentation, there's going to be a couple of multiple choice questions to get some feedback from the listeners. We'll leave the screen on for a second here. If you have a smartphone, you can use the QR code to take a picture of the QR code, and it will bring you to menti.com. Alternatively, you can log on to www.menti.com and enter the code that's on the screen here. That will allow you to participate in some of the polling questions that we have throughout the presentation. I'll leave this on the screen just for a couple of minutes here as I go through our agenda of what we're going to talk about today. And that'll give you a chance to get logged into menti.com. So in the presentation, we're going to be talking about these new rules, both from an individual perspective as well as from a corporation and trust perspective. It's not all bad news. We're going to be talking about the QSBC exemption increase. And so for those companies that have a business that can be sold, there's going to be some advantages when you sell your business one day. The question that we've been getting asked over the past few weeks is whether we should sell investments in a holding company before June 25th or not. And so we're going to walk through some of those considerations and then a related case study on that. And then finally, we'll wrap up with some strategies and considerations on a go-forward basis, given these rule changes and how best to mitigate these impacts that you may be faced with. If we have time at the end, and if there's any questions, we can answer those questions. Please enter those questions into the Zoom chat, and we can address those at the end. So with that, we'll start off with a Menti polling question here. So just to get a sense of our audience and whether you expect there to be an impact in your situation or not. So based off of your current understanding, what impact do you expect to have? Low impact, or no impact, minor impact, moderate impact, or high impact. We'll just wait a couple of minutes and see what results come in. It looks like it's kind of a 50-50, 1/3. So kind of across the board, which is what we would expect. Certainly, if we were to listen to what the government has said, they would say very few people will be impacted, I think 0.1%, but certainly that's not taking into account those individuals that have corporations, because certainly we would expect a fairly large impact on our owner-managed businesses that have saved within a corporation. So we'll start off with the summary of the new rules. This will just be at a super high level. It's not overly complex. For individuals, the first $250,000 of capital gain is going to be treated no differently versus previously. And so a 50% inclusion rate. And then it's for those capital gains in excess of $250,000, that's going to be taxed at a 66 2/3 inclusion rate. So in simple terms, what that means is that if you have $100,000 capital gain, there's not going to be any impact. You're still within the $250,000 exemption. If you were to have, say, a $350,000 capital gain, well, 100,000 of that is going to be taxed at 66 2/3 multiplied by your marginal tax bracket. The first 250 would be taxed at 50% inclusion rate and then multiplied by your marginal tax bracket. For corporations and trusts, there is no exemption. And so on the very first dollar of capital gain, you're going to be taxed at a 66 2/3 inclusion rate. And so for a capital gain in a company, the tax rate would be 25.08%. That's going to be increasing to about 33.4%. And so overall, about a 33% increase in taxation on capital gains going forward after June 25th. For trusts, if you have a capital gain within the trust that's taxed on the trust return, that's going to be similar to a corporation where there's the higher capital gain inclusion rate. In most cases, I would say, a lot of trusts allocate or distribute the taxable income out to the beneficiaries. And so those individuals will continue to have access to their $250,000 personal exemption level. And so as long as the income is being distributed out to beneficiaries, there may not be a significant impact to the trust. It would only be if the capital gain is recognized on the trust return directly. So with respect to the QSBC exemption, if you have a business that can be sold and it meets the qualifying tests, the current exemption level is just over $1 million. That's being increased to $1,250,000 per individual. In a case where you perhaps have multiple shareholders or a family trust that owns the shares of the private company, you would get $1.25 million per individual of exemption room. On a go-forward basis, similar to in the past, that number is going to increase each year with inflation, and so that number will go up from here. In addition to the exemption level that is changing, the government has introduced this Canadian Entrepreneurs Incentive. And so in this case, the capital gain that's in excess of the exemption level is going to be taxable, but it's going to be taxable at a 1/3 inclusion rate, as opposed to previously where it was a 50% inclusion rate. And, on other assets, it's now a 2/3 inclusion rate. But as long as it's a qualifying small business, the tax is actually going to go down on the first $2 million of eligible gains. The government has put out some analysis that shows that the taxpayer who sells their private business is going to be further ahead on the first $6.25 million of sale. It's after that point that they would be paying additional tax compared to the previous rules. And so this is going to be applicable for sales that happen on June 25th or later. Over the past few weeks, financial advisors and accountants have been answering a number of questions from clients on whether to sell or not to sell investments held in corporations. Also investments held personally, but certainly the bulk of the questions have come from corporations, given the fact that there's no $250,000 exemption level. So a couple of considerations that we've been talking to our clients about is length of holding period. So like if you're a long-term investor and you're holding your stock for many, many years, well, perhaps rather than triggering the tax now, you're better off accepting the higher level of tax in the future, but getting that benefit of deferral of many years. And certainly from calculations that we've looked at, you know, that sort of break-even point is around 7 years, assuming kind of an average rate of return. It would take about 7 years before you're better off just holding. So if you have a long-term approach, you know, and you plan to hold for a long term, then that would be a consideration. Similar to length of holding period is age. Like if you're getting up there in age, if you're in your 80s or 90s, you perhaps don't have the benefit of a long deferral period, and so you may be more likely to want to sell prior to June 25th in order to lock in the current inclusion rate, so that you don't run the risk of sort of running out of time and paying a higher rate of tax. Liquidity is, of course, very important. Like just because you want to sell doesn't mean that you're able to sell. And so certainly with stock market investments, you know, they're liquid. You're able to sell those, you know, in most cases, fairly quickly. For individuals or corporations that have like a piece of real estate or, you know, a private company or something that's just not very liquid that takes longer to sell, you may not have enough time to sell in advance. And so you're, in that case, you'd be accepting the higher level of tax in the future. Most likely those assets are long-term assets anyways. If you were to sell a piece of real estate, you know, there'd be other considerations that you would need to take into account, such as land transfer tax, because that would be an additional cost to the transaction. In my view, the most important factor on whether to sell before June 25th or not is your requirement for cash. And so if you're taking remuneration out of the company anyways over the next, you know, 5 years, there's probably a good argument to be had to trigger the gain and take advantage of the CDA account. What the CDA account is that's the capital dividend account, and 50% of the capital gain can be extracted tax-free. So that's the inclusion rate multiplied by the gain. After June 25th, because the inclusion rate is going up, the amount of tax-free CDA that is going to be able to be extracted is going to be a lot less. It's going to be 33 1/3% of your capital gain. And so certainly if you're taking money out of the company anyways, this is a way to lock in, you know, effectively a 25% tax rate, which is much lower than what you would be paying if you were to extract money as a salary or if you were to take it as a dividend. It's important to note the timing. So June 25th is the date where the tax is going to be at the higher rate. And so in order to come in under the old rate, the sale must be effective June 24th or earlier. And so if you're selling marketable securities, be sure to sell them with enough time that not only, you know, has it been entered on your online brokerage account, but it must settle as well. And that takes, you know, an additional 1 or 2 days to settle. So don't leave it to the last minute. Make sure you're doing that in advance if that's what you decide to do. So why don't we do another polling question here? So do you plan to trigger stock market gains prior to June 25th? So not applicable. I don't have a corporation with unrealized gains. No, I have a long-term investment approach. Yes, selectively sell some investments, or yes, sell all investments with capital gains. We'll just give it a couple of minutes and see what results come in. And certainly with these decisions, like there's no right or wrong answer, because it's a very personal decision on whether you want to trigger stock market gains or not, and nobody has a crystal ball either, and so you don't know what the future may hold. I mean, it could be the case where there's a change in government, and perhaps the Conservatives come into power, and it very well could be the case that they reverse some of these rules, and so nobody has a crystal ball, and it's really acting on the best information that you have at the time. So why don't we look at a case study of a scenario where a taxpayer has a corporation. They have a stock portfolio, perhaps $2 million with $400,000 of unrealized gains. They also have some cash that's liquid, and they require $200,000 net after tax per year for the next 4 years. And so in this case, there is a cash requirement. They're going to be taking cash out of the company regardless of whether they trigger a gain or not. And so what we want to look at is, in the scenario like this, are they better off triggering the gain, taking advantage of the CDA, or whether they should just take cash out of the company and defer paying tax on the capital gain into the future. So option A, don't trigger the gains, extract taxable dividends from the company. And what a lot of people maybe sometimes don't think about is, in order to get $200,000 net into your personal pocket, the actual dividend that needs to come out of the company is actually quite a bit higher than this. And so in these numbers, I'm assuming that the taxpayer is in the top marginal rate. And so at the top marginal rate, they're paying about 47% tax on a dividend. And so to get the 200,000, they've got to extract 382,702 from the company to arrive at that after-tax amount. After 4 years, the amount that's been withdrawn and depleted from the corporation is $1,530,808. If we compare that to option B, where that capital gain is triggered pre-June 25th, there's going to be a level of corporate tax, but it's going to be advantageous in that it gives rise to the $200,000 capital dividend account that can be extracted tax-free. And so in the previous example, where we saw that in year one, 382,702 needed to be extracted from the company and a lot of personal tax paid, in this scenario, perhaps in the first year, a tax-free $200,000 dividend can be paid, and then it's just in year 2, 3, and 4 that taxable dividends need to be withdrawn. At the end of the 4 years, the corporate account's been depleted by $1,387,106, and so overall a net benefit of $143,702. And so really kind of the highlighted point here is, if you're extracting money from the company anyways over the course of time, there could be benefit in triggering some gains. On a go-forward basis, the CDA is going to be less attractive because instead of $200,000 being able to be extracted, it would only be $100,000 that could be extracted tax-free after June 25th. So a number of strategies and considerations for individuals. We'll look at corporations shortly. Number one is consider the impact of alternative minimum tax, or AMT for short. What AMT is that's sort of an alternative method for calculating tax on the personal tax return that's compared to sort of the traditional method of calculating the tax. In a scenario where an individual has a lot of tax advantaged income, such as sale of a private business where they're using their capital gain exemption, sale of investments that give rise to capital gains, or perhaps eligible dividends, in this alternative calculation of the tax, it's going to be higher than the regular tax that would be paid. And so there's an additional level of taxation that the individual would pay. This is a prepayment of tax, and so we have 7 years to recover the AMT, but it's a prepayment, and it's only it can only be applied and offset against regular income in the future. And so things like employment income, self-employment income, pension income, RSP withdrawals, that type of thing, types of income that are taxed at a 100% inclusion rate. In the context of the capital gains, in most cases, it's still going to be, if you see that there's going to be an impact on your capital gains, it's still going to be beneficial to trigger those gains prior to June 25th, but you need to take into account this AMT, because the tax that you may end up owing is going to be a little bit higher than what you might be expecting. After June 25th, we would expect that because the inclusion rate is higher and it's not as tax advantaged, the AMT impact would be less. Number two, it's going to be even more important than ever to monitor your year-to-date capital gains and trying to stay within the $250,000 exemption. Where I think the most application is going to come here is if individuals have multiple investment properties, trying to spread the sale of those investment properties over the course of, more than 1 year to try and minimize your capital gain in a particular year to stay below that threshold. Consider asset allocation between personal versus corporate portfolios. And so if you've got sort of a diversified investment strategy where you've got some investments in a holding company, some investments in an RSP, some perhaps in a TFSA, non-registered account, having different buckets of money and capital is going to be even more important than ever. And looking at those portfolios and trying to manage the investments within them, to have like your growth stocks that you haven't bought for interest or dividends, but for capital appreciation. Well, try and have those stocks in a personal portfolio where you're going to be able to either shelter the gain within like a tax-free savings account or an RSP, or in a non-registered account where you're going to be under the old rules of a 50% inclusion rate. Use of reserve is going to be something that I think we see more regularly. A reserve comes into effect when you sell an asset, but you haven't collected all of the cash in year one. And so in a scenario where you sell, say, a piece of property and you take back a vendor take-back loan for a portion of the proceeds, we can defer that portion of the gain where you haven't received the cash to the future year when you actually receive those proceeds. And so, as an example, if let's say you had an investment property and you had a $500,000 capital gain, and let's say you sold it in December, well, you could perhaps arrange with the purchaser to say, okay, well, let's receive 50% of the proceeds in December. Let's receive the remaining 50% in January. So from a timing perspective, you're not terribly bruised. And what that effectively has done is pushed half of your gain into the following year, such that that $500,000 gain has now been split, and you're going to be under the $250,000 exemption in both of those years. And so I think the use of reserves is going to be more relevant, and certainly, like for many years, we've seen the use of reserves come into effect on transition of family cottages, where perhaps mom and dad are getting up in age and want to pass it to the next generation. Well, in that scenario, they would sell at fair market value to the next generation, but then rather than receiving all the cash, or if it was a gift, if it was going to be forgiven, uh, spread it out over 5 years. At a minimum, we need to report 20% of the gain per year. But if we can spread it over 5 years, then that's going to have less of an impact with respect to these rules, but also other factors such as OAS clawback and things like that. Joint ownership is going to be something that individuals should consider more often. And so think of purchases of real estate, purchases of cottages, stock portfolios being in joint accounts. That's going to provide more flexibility and allow future gains to be split between spouses. Something that we do need to be mindful of is spousal attribution. So in a case where, let's say there's a high income spouse and a low income spouse, and the high income spouse has generated a bunch of income and wants to use that money for an investment purpose, well, we can't just arbitrarily assign half of the value to this new asset to the low income spouse because they weren't part of the contribution of that capital. And so we would need to be careful of that. If attribution does apply, then any income and the ultimate capital gain would attribute back to the original spouse. There's a few ways to get around this, the most common being spousal loans, certainly with interest rates being higher now than where they were a few years ago. Spousal loans are not as popular, but as interest rates start to come down, that's going to be an important planning factor. And then finally, take advantage of the various tax advantaged investment accounts. And so rather than having all of your investments in a non-registered account that is going to be taxable and potentially subject to this higher inclusion rate, make sure that you've topped up your TFSAs, your RSPs, the FHSA, which is the First Home Savings Plan, which is new in 2023, our ESPs and our DSPs, which is Retirement Disability Savings Plans. With the FHSA, I just wanted to chat a little bit about that because it is new in 2023. What this is for individuals that are looking to purchase their first qualifying home. And it's similar to an RSP in that when you make a contribution into the FHSA, you get a deduction against your income. That amount is a maximum of $8,000 per year of contribution room, up to a maximum of $40,000. So $8,000 per year over 5 years. What's important to note is that you only accumulate the room when you have opened up an account. And so even if you're not ready to contribute money into an FHSA, because you think, I'm several years away from purchasing a home, or if I have kids or grandkids that are several years away from purchasing a home, well, it's good to register for one of these accounts at your bank so that you at least accumulate that room so that when you are ready, you can put the money in and take advantage of that deduction. It's similar to a tax-free savings account in that when you take the money out, you're not going to be taxed on it as long as it's being put towards one of these qualifying homes. And if by chance you don't end up purchasing a home, you can roll this money into your RSP at some point in the future. So the FHSA, I think, is very powerful. And even if that's not a situation you're in, you may have kids or grandkids that could take advantage of this. So in terms of some considerations for corporations, number one, if your company has a credit shareholder balance, if we know that capital gains in a company are going to be taxed at a higher rate, well, if the company owes you money and you have that pipeline to pull it out tax-free, it may make sense to pull the cash out to invest personally. There are some downsides to that, like number one, if you've got your investment assets in a corporation for estate planning purposes to try and mitigate probate, well then, if you now have a personal account it could be subject to probate. And so you would need to weigh sort of that probate cost versus the higher capital gains tax cost to see which option you would want to move towards. RSP contribution room, like oftentimes we see individuals saving money within a holding company because they have a little bit more flexibility on withdrawals and sort of being with an RSP, you're forced to convert to a RIF and take it out at some point. We don't have those limitations with a corporation, but for individuals that have like large amounts of RSP contribution room, there may be benefits in withdrawing like a lump sum from your company in order to put into an RSP. If you take that money out as a dividend or as a bonus, you're going to get an offsetting RSP deduction. And so you're not going to have a huge income inclusion in the year that you do that. In the case where you pay a bonus to yourself, the company is going to get a tax deduction. And so you're going to save some corporate tax, and then it's going to be a wash on your personal return. And if you transfer the cash directly from your corporation to your brokerage account, you don't need to withhold source deductions. And so it's a little bit more tax efficient rather than taking, the after tax or taking your net payout if some source deductions have been paid and investing that, smaller amount into an RSP. You're going to be able to do a larger sum. You just need to make sure that that does get reported on your T4 because it is taxable income. IPPs or individual pension plans are going to be more relevant under these new rules as a tool of withdrawing and extracting more cash from the company to invest outside of the corporate structure. And so with IPPs, these are determined by actuaries on how much money can be put into the pension plan. In most cases, it's going to be a larger amount than what you could contribute into an RSP. And so that's really where the primary advantage comes from. People that are between age 40 to 55 are probably the best demographic for IPPs. And especially if you're a high income earner and if you have a history of paying yourself a salary, there could be the added advantage of doing sort of an additional catch-up payment early on in the plan. Number 4, donation of securities with large unrealized gains. And so a lot of companies have stock positions if they've held for a long time. There might be a huge unrealized gain. If you're inclined to make a charitable donation, a lot of people write checks from their personal account, give their credit card number, and that's really not a tax effective way of making a donation. If you've got stock in a company that has a huge gain, consider making a donation of that stock. And there's 3 primary benefits of doing that. Number 1 is when you donate that stock that has that unrealized gain, you don't pay tax on that capital gain. Number 2, you get the full deduction of that donation against your other corporate income. And number 3, to the extent of the size of the capital gain, let's say there's a $10,000 capital gain that is sort of part of that stock, that full amount gets added to your CDA account. And what we saw earlier is that the CDA can be extracted out of the company completely tax-free. And so there's 3 big benefits of donating stock from a company. And so that's certainly worthwhile considering if you've got some stocks that have appreciated significantly. And then the last point here is making sure that your company, if it's a company that you think can be sold one day, making sure that you qualify for that sale. Because of the higher capital gains and the added benefits of the QSBC capital gain exemption, it's just really important to make sure that you qualify. And in order to qualify, there's 3 tests that need to be made. Number 1 is you need to have held the shares for 24 months or longer. Number 2, for the 24 months leading up to the sale, more than 50% of the assets need to be business related. So you can't have a huge stock portfolio in a company that is greater than 50% of the total assets. And then at the moment of sale, 90% of the assets need to be business related or active. And so making sure that those three tests are made is going to be really important. And that would involve purifications from your operating company into a holding company, and also consider whether the ownership of the company is such that you're able to multiply the capital gain exemptions. And so although the capital gain exemption is being expanded, if you can add multiple shareholders or family members, then that would be even more beneficial. And so that would be through like a freeze, introduction of family members directly, or through a family trust. So with that, the content for the webinar is completed. And so certainly we're happy to take some questions. Do follow us on LinkedIn and subscribe to our YouTube channel so that you can watch previous webinars and be up to date on future webinars, which we try and host monthly. So with that, why don't we see if there's any questions? Maybe just give a couple of minutes here to see if there's any questions that roll in, but thank you to everybody who joined us today, and hopefully there's a few points that you can take back and consider in your situation.